Hi, this is Dave Downing, financial planner with Waypoint Partners, and this is your Waypoint Virtual Minute. When you invest, it's easy to focus on whether your account balance is going up or down, but behind that number is something much more meaningful, your total return. Total return is simply a combination of everything your investment gives back to you over time, and understanding the pieces that make it up can help you stick with your investment game plan. There are two main components to total return: price appreciation and investment income. Price appreciation is the part that most people think about. When the value of a stock, bond, or fund increases, that growth contributes to your return. If you bought an investment for $100 and it is now worth $120, that $20 gain is price appreciation. From a tax standpoint, appreciation isn't taxed while it's growing. It only becomes taxable when you sell the investment. The exception to this is mutual fund capital gains distributions, which we've covered in another video. If you've held the investment for more than a year, it's typically taxed at long-term capital gains rates, which are generally lower than ordinary income tax rates. If you sell sooner, short-term capital gains taxes apply, which are typically at your regular income rate. The second component to total return is investment income. Many investments pay periodically along the way. Stocks may pay dividends, bonds pay interest, and other investments like real estate may distribute rental income. These payments are independent of the price appreciation of the investment, but contribute towards your total return. Dividend and interest income is usually taxable the year you receive it. Interest is typically taxed at ordinary income, while dividends may qualify for lower tax rates if they meet certain requirements. When you put these pieces together, you get total return. It's the most complete picture of how your portfolio is actually performing, and it's a reminder that returns don't come just from one place. Some years your growth may come mostly from market appreciation. Other years, like when markets are down, income may play a much bigger role. Over long periods, it's the combination that drives your progress. When doing retirement analysis for clients, they often ask how they will be able to live off the investment interest generated by their portfolio. Although we understand the context of the question, we think there's a much better way to frame it. The better question is, based on my tolerance for risk, what long-term total return should I expect in my portfolio, and will that support my retirement lifestyle? This acknowledges that both components of total return, appreciation and income, are important in your success in meeting your goals. If you focus on one aspect too much, it may cause a lack of diversification and hurt your long-term portfolio. If you familiarize yourself with the components of your portfolio, you broaden your horizons as an investor. Total return is what moves your portfolio towards your goals, and that's the number that really matters.